If you invested just $1,000 today and never added another cent, that money could be worth over $17,000 in 30 years. That's not a promise. That's what historically happens when you put money into a low-cost index fund and leave it alone. Based on the S&P 500's average annual return of roughly 10% over the past 50 years, a single $1,000 investment compounds to $17,449 by year 30. $1,000, 30 years, $17,000 from doing nothing. So if you've been sitting on cash and wondering where to start, this video is exactly where you start. Here's what I hear all the time. I want to invest, but I don't know where to begin. And I get it. The internet is full of people shouting about crypto, hot stocks, and this one ticker you need to buy right now. It feels like you need a finance degree just to open an account. You don't. Investing your first $1,000 is genuinely simple if someone just walks you through it step by step with real numbers and no jargon. That's what we're doing today. By the end of this video, you'll know exactly where to put your money, what to buy, and how to set it up so it keeps working without you having to think about it every day. Let's go. Before you buy a single share of anything, you need to answer one question honestly. Is this money you can leave untouched for at least 5 years? Investing is a long game. The S&P 500 has had years where it dropped 20%, even 30%. In 2022, it fell almost 19% in a single year. If you needed that money in 6 months to pay rent, you'd have had to sell at a loss. So here's the rule. Your $1,000 should only go into the market if 1. You have at least 1 to 3 months of living expenses saved separately in a bank account as an emergency fund. If you don't, build that first. 2. You don't have any high-interest debt, like credit cards above 15% APR. Paying off 20% interest debt is literally a guaranteed 20% return. Nothing in the market beats that reliably. 3. You won't need this money for at least 5 years. If you check all 3 boxes, great. Your $1,000 is ready. Let's put it to work. You need a brokerage account. Think of it like a container. It holds your investments the same way a bank account holds your cash. For a beginner with $1,000, you have 2 main options. Option A, a taxable brokerage account. This is the most flexible. You can put in any amount, take the money out whenever you want, and invest in almost anything. Option B, a Roth IRA. This is a retirement account with a huge tax advantage. Your money grows completely tax-free. You pay taxes on the money going in, but everything it earns over 20 or 30 years? Tax-free. The 2026 contribution limit is $7,000 per year. If you're under 50 and you qualify income-wise, I'd strongly suggest starting here. We'll do a full deep dive on Roth IRAs in the next video, but for now, know that if you have $1,000 and you're investing for retirement, a Roth IRA is almost always the better first account. Now, which platform do you open it on? For simplicity and zero commission trades, Robinhood is one of the cleanest starting points for beginners. The interface is genuinely simple. There are no trading fees, and you can open either a taxable account or a Roth IRA directly in the app. You can get started with as little as $1, and right now, they're offering a sign-up bonus for new accounts. I'll put the link in the description below. If you want something more automated, where you set a portfolio once and the platform rebalances it for you, M1 Finance is also excellent and worth looking at, especially once you're contributing regularly. Link for that is in the description too. But for your first $1,000 today, pick one, open an account, and fund it. The whole process takes about 10 minutes. This is where most people overthink it. They spend weeks reading about individual stocks and end up buying nothing. Here's the truth, backed by decades of data. Most actively managed funds underperform the market. According to the SPIVA scorecard, which tracks fund performance, over a 20-year period, roughly 90% of actively managed large-cap funds have failed to beat the S&P 500 index. So instead of trying to pick winners, you just own the whole market. That's what an index fund does. It's a single fund that holds tiny pieces of hundreds or thousands of companies. When the market goes up, you go up. You never have to pick stocks. For your $1,000, here are 3 simple options. Pick one. Option 1, VOO, Vanguard S&P 500 ETF. This tracks the 500 largest U.S. companies. Apple, Microsoft, Amazon, Google, they're all in here. One share of VOO costs roughly $530 as of early 2026. With $1,000, you could buy one share and have $470 left to add to the same fund over time. Expense ratio, 0.03% per year. That means on $1,000, you pay 30 cents a year in fees, effectively free. Option 2, VTI, Vanguard Total Stock Market ETF. This is similar to VOO but broader. It holds over 3,700 U.S. companies, including smaller ones, slightly more diversified. Expense ratio also 0.03%. Price per share around $265, so $1,000 gets you about 3 to 4 shares. Option 3, FXAIX Fidelity 500 Index Fund. If you open at Fidelity, this is their S&P 500 Index Fund. No minimum investment. Expense ratio of 0.015%, essentially zero. You can invest with any dollar amount, so $1,000 goes in all at once. My recommendation for someone starting today with $1,000, if you opened a Roth IRA at Fidelity, buy FXAIX. If you opened at Robinhood, buy VOO or VTI. Hold it. Add to it every month. Don't check the price every day. Let me show you what that looks like with numbers. $1,000 in VOO today. You add $100 a month after that. That's roughly $3 a day, or skipping a few coffees a week. Assuming the S&P 500's historical average of 10% annually, which is what backtested data shows over the past 50 years, though past performance doesn't guarantee future results, in year 5, you'd have around $8,700. In year 10, around $21,000. In year 20, around $77,000. In year 30, around $228,000. That's the power of compound interest. You didn't do anything special. You bought one simple fund, added $100 a month, and left it alone. The single biggest mistake new investors make is thinking they need to actively manage their money. You don't. In fact, the more you touch it, the more likely you are to panic sell during a downturn and lock in losses. Here's what you do instead. Set up automatic contributions. Most brokerages let you schedule a recurring transfer from your bank account. Set it to $50, $100, $200, whatever you can manage, on the same day every month. The day after payday works well. This is called dollar cost averaging. Instead of trying to time the market, which even professionals fail at, you buy a fixed dollar amount regularly. When prices are high, you buy fewer shares. When prices dip, you buy more. Over time, your average cost stays reasonable. Historically, consistent monthly investing has outperformed lump sum attempts to time the market in the majority of 10-year windows. You can set this up in literally 2 minutes in any major brokerage app. Don't watch the balance daily. Seriously, the market will go down sometimes. It went down in 2000, in 2008, in 2020, and in 2022. Every single time, it eventually recovered and went higher. The people who kept investing through those drops made more money than the people who pulled out. Quick note on taxes, because this matters more than most beginners realize. If you invest in a regular taxable brokerage account, you'll owe taxes on your gains when you sell. Short-term gains, held under a year, are taxed as ordinary income, potentially 22%, 24%, or higher. Long-term gains, held over a year, are taxed at 0%, 15%, or 20% depending on your income. If you invest inside a Roth IRA, all of that growth is completely tax-free. You pay no capital gains tax, ever, on potentially hundreds of thousands of dollars. That difference is enormous over 30 years. Always maximize your Roth IRA before a taxable account if you're eligible. In 2026, you can contribute up to $7,000 to a Roth IRA if you're under 50. Your $1,000 is a great first contribution toward that limit. Let's bring this together. Here's your step-by-step action plan for investing your first $1,000. Step 1. Confirm your money is ready. Emergency fund exists, no high-interest debt. You won't need this for 5 or more years. Step 2. Open an account, a Roth IRA if you qualify, or a taxable brokerage account. Robinhood is a clean, simple starting point. Link in the description. Step 3. Buy one simple index fund, VOO, VTI, or FXAIX. Don't overthink this. One is enough. Step 4. Automate a monthly contribution. Even $50 changes the math dramatically over time. Step 5. Don't touch it. Don't watch it every day. Let compound interest do the work. That's it. That's the whole playbook for your first $1,000. Now here's what I want you to do right now. Drop a comment below and tell me, where are you in this process? Have you already opened an account? Still figuring out which platform? Or is this the first time you felt like you actually understand what to do? I read every comment, and your question might become our next video. And if you want to know exactly how a Roth IRA works, including the 2026 contribution limits, income limits, and why it's one of the most powerful accounts available to regular people, the next video is already up. Watch it next. This video is for educational purposes only and is not financial advice. Always consult a licensed financial advisor before making investment decisions.